There is overwhelming evidence that paying an active manager to try to outperform the market is a waste of money. Only a small fraction of active managers beat comparable index funds over the long run on a cost and risk adjusted basis. But even index funds need to trade, because different index funds have different rules on buying and selling. Even funds tracking the same index will have a dispersion of returns. In that sense, index funds are more active than people think. Marlena Lee is Global Head of Investment Solutions for Dimensional Fund Advisors.
All index providers, they have to make choices. Even when we're talking about a broad market index that might be market cap weighted, there are still rules around when it's going to add or drop securities, because the market out there has tons and tons of stocks that actually are not included in some of the major indices. So even across those plain vanilla market indices, we do still see differences, dispersion in returns. So none of these indices are representing what, the broadest sense of the market.
Most index fund managers do most of their buying and selling at around the same time, usually on the same day that the index is reconstituted. That can put index funds at a disadvantage.
Some of the major decisions that an index has to make is what stocks to add or delete, but then also when to do that and when to rebalance or reconstitute the index. Most indices reconstitute only a couple times a year, either once or 4 times a year. And by waiting on those days to rebalance the portfolio, that implies a few things. First, there might be some style drift, which means that you might not be fully focused on the areas of higher expected return that you want to be focused on. There's also just really focusing that turnover and that trading associated with that turnover into a handful of days of the year. That implies that indices are going to, all of the index funds that track that index are going to be buying or selling at the exact same time. And some of these indices have a lot of assets tracking them, which means that there could be some price pressure associated with it.
A good example of the negative impact the so-called reconstitution effect can have on index fund returns is the case of Tesla. The electric car maker was admitted to the S&P 500 in December 2020.
First, the index has to announce that they are going to add Tesla. There's usually a period before the index announces and then actually adds the name. So in the case of Tesla, we saw a pretty substantial price run up in the Tesla stock, leading to that time where it was actually going to be added to the index. And then immediately following, there's a little bit of price reduction. And that's what we would call a reconstitution effect. Basically, the index is buying high, which of course is not what the goal is if you want to maximize returns. So we run something that looks very, very, very similar to the S&P 500. We just will give it a little bit of flexibility around that reconstitution date. We won't add Tesla stock exactly at the same time an index that's tracking the S&P 500 will add it.
But Tesla is just one example of how a fund manager like Dimensional with a flexible trading strategy can outperform traditional index funds. Another came with the special rebalance announced by the Nasdaq 100 in July 2023.
The Nasdaq 100, which is the 100 largest names roughly in the US market, so we're talking about mega caps here, they announced a special rebalance because the Mag 7 stocks, right, those are those big growth tech names in the US, they were getting too big in the index. So they announced a special rebalance whereby they were going to trim some of the names back and then spread that additional weight pro rata across the rest of the names in the index. What we saw is that if we just rebalance that index a little bit early. So when they announced the special rebalance, instead of on the rebalance day, which is when any other index manager that was tracking this index would have needed to rebalance, the return differential there was we were estimating about a 40 basis points higher return by just rebalancing the index ahead of when everyone else was going to rebalance. So again, this reconstitution effect can be meaningful even within the most liquid names in the market.
As we've seen, Dimensional's flexible trading strategy gives it a definite edge over traditional index funds. Another big advantage is the additional exposure Dimensional funds have to factors that have delivered higher returns over time. These were identified by Eugene Farmer and Kenneth French in their many asset pricing academic papers, culminating in their 2014 paper, A 5-Factor Asset Pricing Model. The 5 factors are market, size, value, profitability, and investment.
Index funds are a great starting point for a lot of investors. You get a great, well-diversified, low-turnover solution. So relative to a traditional active manager, I would say absolutely, let's go into an index fund. But an index fund does have some rigidities associated with it. If you want to minimize tracking error to the index, you're going to have to trade at the same time as a lot of other assets are trading. And that just leads to some money being left on the table. By having a more flexible approach, by avoiding trading when everyone else is trading, you can save on trading costs. But then the systematic side of it is there still is a great way of pursuing higher expected returns than just a market portfolio. And rather than relying on a star manager or trying to pick individual stocks or time markets, there is a better way. Not all stocks have the same expected return. And by relying on decades of academic research to identify those areas of the market with higher expected return, you can have a much more robust way of pursuing expected outperformance to the market. And Dimensional's been around for over 4 decades, and we have a great track record of success of beating indices, beating active managers by employing this systematic approach. It's really bringing academic research to life for our clients.
In short, low-cost index funds are an excellent starting point for investors. But the fact that they have to trade at the same time is a major disadvantage. Dimensional's flexible trading strategy enables it to benefit from specific developments. Combined with its evidence-based investment philosophy, this flexibility means it generally outperforms traditional passive funds in the long run.
What you really need to be using then are what the Securities and Exchange Commission refers to as non-traditional index funds. These funds are based on factors like those in the Farmer-French 5-factor model, which the long-term data tell us are drivers of higher expected returns.
Thank you to Marlena Lee from Dimensional Fund Advisors and to you for watching.